delay here. This is weekly review, May 10th. We're doing the review for the 8th, of course, and beautiful day here in Portland. If we look at the progress of the market has once again proven almost impossible to stop. You can see it here with S&P, the broad market, getting 3.5, 6 on the NDX, a little bit less. Or well, actually on the NASDAQ, a little bit less on the NDX. Small caps had a nice big gain. You actually had gains again in gold and junk bonds. Bonds themselves, treasuries, right, got hit and dollar was up. Year to date, you're positive now, NDX and the NASDAQ. Still down 20% on the small caps, almost 10% on the S&P. And that's kind of the way it shapes up. If we go into this and we start looking at the technical picture now, this week, what I'm going to do is something a little bit different than I've done before, and we're going to get into what can we do to actually make money in this market, given that it won't, or at least so far has refused to come back in. But if we look at the technical picture, right, we got a swing point high now here because we've gone more than 6 bars. That swing point high potentially can get broken as this market moves right back up to test again. And there's another one over here. You get all this resistance based on this, which is the top of that, which is just above that swing point high. That is what we've been thinking is going to be the range. And we've kind of been thinking the range is from here to here on a longer term basis, on a weekly basis actually. So far, we're hanging at the top of that area. So is it going to break down? Is it not? Well, if you just left it to the S&P, maybe it would. But if you look over at what the S&P is doing, it is trying to set up another ABCD structure to get up above that level. And you got the NDX helping to pull this thing along in the NASDAQ itself. So this is the second test. In other words, we broke out here, tested there, held, popped back up, came back in, tested again, just barely. And now the second time we're generating back up. Now, if this fails and comes back in, probabilities of breaking, pretty good. Right, you're down into the 30s in terms of percentages, and so this is a big area. And so far, it's consolidated up here, right? Which is what you really want it to do. You want it to come down, come back up, right? Consolidate, and then eventually break out. It's eating up the supply line that's in this area. That's what it's doing. It's slowly eating it up. NDX, of course, is helping to pull this thing up. So the NASDAQ NDX 100 has been pulling this thing up. Got a V-shaped reversal. You're back into this gap area now. The only thing above that, of course, is this bar, which is swing point high. So it just barrels higher and higher and continues to pull everything with it. And we've talked about it over and over, saying, you know what, the NDX 100, the big mega cap stocks, the technology guys, they're the ones pushing everything, right? They're actually pulling everything else up. That's kind of true in this week. I'm going to show you why that's not exactly the case and how we can try and profit by that, and we'll do that here in a second. If we look at the technical picture continuing, right, S&P, now we're on the weekly. There still is an ABCD structure, or actually there is an ABCD structure now in place. You had a high here, you had a low there, which was lower than that low. That sets up the potential for this large ABCD structure to take this up to new highs. Will it do it? That's a different question. The potential is there. But we still have that bearish potential, right? That's still out there too. That hasn't changed just as it was last week. Let's go into what's really happening underneath the covers, because it's fairly clear that what we have in this market at this point is we've got some dichotomies that exist in terms of what's going up, what's going down. And those things are not what was in place 3 months ago, right? It's only in the last 2 to 3 months that these things have changed. And if we make some assumptions, we can say, you know what, maybe these changes are going to stay a more permanent fixture of this market, and we can potentially take effect of that. So let me run you through what I did, and I'm still doing actually, but I'm sharing it with you because there's enough here to do. I've shared a watch list called New Highs with you. You can go out and pull that up. That's just a shared watch list out there. And if you pull that up, you'll see all the stocks that have made new highs on the NASDAQ, the AMEX, and the NYSE. There's 564 of them. And that was to the February high. So I took the highs in February, I think it was the 19th, if I remember right. And I said, you know, is there anything higher than that now? And there's 564 stocks higher. Of those, of the ones that we track, right? Of those, and we track 7,000. Of those, right, we know that, that even though we don't believe, or at least I have a hard time believing that we're going to find a way to get higher, make new highs. You know, if we do, I got to find a way to participate. And so far I've been doing that through my gold and silver. You know, I've talked about gold and silver. I continue to be invested in gold and silver, but that's pretty much what I'm in. Almost everything else is cash and has been for a while. Missed this whole plunge as a result of that, trying to make some money on the way up in these two areas. But you know what? The question is there other areas? And there is, and that's what I'm going to show you. But this overwhelming central bank liquidity, right? You know, can it just take us back to new highs? Is it just the 5 or 6 mega cap winners out there? And the answer is no, right? There's other new winners, and we can exploit that. And I'm going to show those to you. Now, what I did is I took these 564, I divide them into industries. There's over 130 industries, but if you consolidate that group, you end up with a few mega industries, if you will. And let's walk through them and see what they are. So here's the groupings. You can see that biotech's got the most in software, medical, appliances, gold and silver, application software, etc. Right on down the list. Now, two of them seems like anomalies. One is this oil and gas. I'm not really sure if I believe in it. And I don't believe in this REIT either. All these other ones kind of make sense, right? If you look at them and you look what's been happening, those all seem to make sense with what we see on the ground. So if you distill that list, right, in other words, group those again, right, kind of the new world winners, if you will, longer term, both now and longer term. There's health-related companies, so that's like biotech, drug manufacturers, distributors, medical equipment, etc. Right? All those things, 219 stocks in that group. Software-related, whether it has to do with educational or whatever it may be. There's a bunch of software stocks. There's also some software stocks tied to these internet-related, both application infrastructure, and then some specialty retailers, which are kind of like software stocks, but they're using their software on the internet to sell things, retail things. A lot of these are even like educational stocks, allowing medical, remote medical doctors to remotely work with patients, K through 12 education software, etc. There's a lot of those. Gold and silver, we already talked about. There's semiconductors that are mainly supporting internet and some of these others, but primarily here. There's food related, whether it has to be with selling food, the retailers, or actually supplying it or distributing it, and then those anomalies I was talking about. So when you group this, right, there's really, look here, 1, 2, 3, you got 2, 4, 6 of them, right, basically, and most of them fall in those groups. The big money trends, if you look at that group, right, the big money trends seem to be moving into these areas, right, in a big way. There's the healthcare, the software, the gold and silver, hardware, and food. If you make these assumptions here, right, then you would say, hey, these things can actually continue. And so the virus, it looks like it's going to be with us for months, maybe a year or two. And the majority of the population are going to continue their life patterns that they've had the last couple of months for another year or longer. If these are true, right, then I suspect these have farther to move. And even if they dip, will be supported and bought again. And that's the key, right? It's like we want to put our money, if we're going to buy stuff in this market, we want to buy stuff that we know if it dips, the buyers are still there. We got the wind behind our back. We got the big money coming in to support us. And it looks like these are the groups, right? Food also. So assuming that, right, if you look at the NDX, we've been talking about the mega caps causing it. I put this up because it was kind of amazing. 21 out of the last 31 days been gap up. All this move up. And just look at the strength in this thing. You had a little correction here, a little correction there, and a little correction here over a 7-week period. And they came right back in and sucked it back up and just bought it and took it back higher. And it looks to me, they're up in this gap area now, it looks to me they're going to try to close this gap and potentially make new highs. And so the NDX has been crushing it, right? And we keep saying it's the mega caps. Well, it's not just the mega caps, as I just showed. And you can see that clearly because if I group these things into the NASDAQ and the NYSE where they are listed, so I went and took those companies and broke them down into NASDAQ or NYSE or the AMEX. And when I did that, software, hardware, and biotech, which we all know are in the NASDAQ primarily, 383 stocks in those groups listed on the NASDAQ. 148, which is primarily these, are on the NYSE. So about 3 to 1 almost, you know, a little less. So that's why this continues to be the strongest sector, because it has the most stocks pushing higher, right? Making new highs. That's really what's happening underneath the thing. So it's not just the mega caps. And so, you know, excuse me for saying that. The mega caps are very obvious, but it's not just the mega caps, right? It's software, hardware, and biotech. And then there are the other groups that are pushing in the NYSE. So how do you take advantage of this, right? Well, my plan, I'm just going to lay it out to you, is I'm not going to just run out and load up on these long, you know, load up on the long side of these stocks. I'm not going to go pick, you know, 15, 20 of them, just buy them. I'm going to selectively enter with some percentage of my funds. The vast majority of my funds, 90% right now, as of this video, 90% of my funds are sitting in cash. I'm going to take maybe 20% of that, maybe 25, I don't know, maybe 30, some number, depending on what I see, right? And I'm going to buy either, you know, all with neoclassical entry points. I'm going to either buy breakouts on multiple time frames where there's no obvious resistance above, or I'm going to look for retraces with high probability regeneration setups and use those to deploy this much money. Now, why this much? Well, because if I get an entry and it continues down, I want to be able to take another 20 or 30%, right, and go in and buy it again. The same thing. I'm not going to go into something new probably unless these fail, and clearly have failed. I want to go in and buy it again. Why is that? Because I believe that those assumptions that we showed over there are probably true, and that more than likely when these dip, the buyers are going to come back in and buy them again. And so I want to allocate money here, get the push up if I can get it, sell some, reallocate to another one that's setting up again, etc., right? And play this group back and forth with that amount of money. And when this market really does find a range top and starts trading in a range, then the retraces will be the things to buy, not the breakouts. Right now, these are the ones that are leading, and we can put more money into the retrace in those stocks that still make sense. And so that's a way to try and take advantage of this. Even though I have a hard time believing that this market is something I want to invest in, you know, I'm willing to invest in gold and silver. Why? Because I know there's big money underneath, right? Well, if I know there's big money underneath in software, or I know there's big money underneath in maybe the chips, or wherever it is, right? I can also do the same thing I'm doing there with gold and silver in these other groups, and that's all I'm saying here. Other places we can try and do that. So here's a couple of examples. And I've only just pulled up the first two I saw technically. I've not looked at this company. I've not even looked to see what they do other than to see that they're in the biotech. And so I've said, okay, well, look at this. This thing came down, broke, well, came way down, right? Came all the way back up. Again, look at all the swing point lows that print without one single swing point high. That tells you how strong it is. Here it is breaking out on the daily, breaking out on the weekly, and if I had put the monthly in, it was breaking out there as well. And so you've got breakouts on all these time frames, right? You got nice volume buildup on these breakouts. This is something you can buy on a breakout. And so I will look over the rest of the stocks today in more detail, and this may be one that I approach tomorrow to buy on that breakout idea. You could also look at the retrace. And so here's CIEN, which is like infrastructure, telecom. Breaks out right here on a weekly. There's the swing point high and a swing point high. It already broke out previously here on these two swing point highs. But notice as it broke out on this one, right, it had overhead resistance. So that wouldn't be a breakout multiple time frames with no overhead resistance. That one had overhead resistance. It gets up, spikes up, comes back down, hasn't tested back into these two swing point highs, but if it does, it's probably a pretty good place to buy it, right? And so now that we have this breakout, if this one comes back, even if it doesn't get this deep, if it gets back into these two, it probably would be a decent buy, but certainly if it gets back into this area right here, that's a good high probability buy off of this swing point highs low and this swing point highs low. More than likely, we're going to see the money come back in somewhere down in this area and try to take this thing higher. CIEN, another one on a retrace, right? So that's on the retrace case. All right, so what's the bottom line here? There's simply too much money chasing the stocks. We've seen that before. We saw it for a decade. Every time the Fed central bank would come in, they push these things up, put so much money in the system, it chased the stocks. And that's what we're seeing again. It's overwhelming. They're putting in $8 billion this week. They were putting as much as $35 billion a week. You know that we've tacked on $2+ trillion now in the last 7 weeks, I think it is. We took on something like $2 trillion in debt on the government. It's insane numbers that we're talking about out here, but when you got so much money coming into the system, you're going to see them chase stocks up, and that's what they're doing again. Logically, it just doesn't make any sense, given what we see on the ground fundamentally. I mean, things are horrible. I mean, you and I all see the numbers. But with that much money coming into the system, it just doesn't matter, right? Doesn't matter until it does. If we concentrate what we are willing to buy into these stocks that are benefiting the most, right, in this new world order as things change around, then we should be able to benefit and be able to benefit in a bigger way. I've been doing that with gold and silver. I think it's true or will be true of these other groups. The major opposing forces are still out there. This hasn't changed, right? There's this fear of missing out, and that's what's pushing this market up, as well as all this endless bailouts and central bank liquidity that's been pushed in the system. And that's all juxtaposed against the massive supply and demand shocks, right, that are out there, the supply chain disruptions and the virus fears. And you got these two opposing forces. This one right now is winning. There's just so much money coming into the system, and this fear of missing out again is pushing this market higher. I still expect at some point we're going to get some sort of a range to set up, but it may not be here. It may be at the new highs. I don't know where it's going to be. All I know is right now it won't fail and it hasn't failed. And we got to find a way to take advantage of it. And so we don't have to do it just in gold and silver. We can look at some of these others which we've kind of tried to discover here. So this still suggests, right, that there's going to be this long-term range, right, but it ain't there yet. And when it finally prints, the question will be, what's the bottom? So once we figure out this, then the question is going to be, where is this? But we're not even to that point yet to even try and decipher that. Okay, fundamental political. Last week, a lot of bad numbers again. Look at all these worse than expecteds. A little bit better than, actually it wasn't better, there wasn't an expectation. But almost everything worse than expected, whether in Europe or whether you're here in the US. Even the non-payrolls, they were better at 20 million lost jobs. This week is the last week for, well, actually, that's on the next page. There's this demand destruction. The real question is it going to persist and how long? We're starting to open up the country again, or we're going to have a resurgence of virus and have to shut things right back down. And we're seeing some of that in Germany, some of that in Singapore, in Korea, and some of these other places. It's not massive. Of course, Korea never even shut down because they had a better approach to the way this was done versus just shutting everything down like we did mostly across Europe, other than Sweden and here in the US. We just shut everything down, stop everything. Most of these other countries had good testing in place and were allowing infections to take place, but at a rate that they could manage. We just did the, spike up, shut everything down, and try to pull it back down. Different approach. I think this was a better approach, but we didn't have testing in place to do that. We squandered our opportunities there. Doesn't appear that there's any more free money coming from Congress now. It looks like that finally has stopped. So it's really the Fed's pumping in. It's down from 300, but they're still pumping in 30 to 40 billion a week. The most impactful data this next week, there's not a lot actually that's worth looking at. I think these retail sales might be big here in the US because that will give us some of that demand question. What kind of end user demand do we have? Industrial production, we suspect, is going to be bad, both Europe and here. Earnings, last big week, right? Retailers this week will wrap things up. Last week, it was better than expected again. And if we look at it this week, where do we think it can go? I think best case is you go up and you test into this high. So you break out over here, you take up, and then you pull back some. Most likely case, you break this high, but you kind of mill around, just stay in the same area again. And so again, you chew up some more of this supply. Worst case, probably just come down these swing point lows. That's where it is, folks. Have yourself a great one. Stay safe. I'll see you next time.